It's Sunday night. You're watching First Call. I'm your host, Chris Vecchio. He's Ilya Spivak. This is tastylive. We're here to get your trading week started. Another week entering week 4 of the U.S.-Iran war. Oh, exciting stuff out here from the producers. Ilya, before we get into it on a weekend of dramatic headlines, how was your weekend?
It's just the most perfect weather here in San Francisco. So it's been a weekend of just hanging out outside and enjoying it.
Yeah, it was pretty good here too. I'll tell you that when we take a look at the markets here, I just don't have anything. All I've been doing is following the news, quite frankly. Probably not the healthiest way to spend one's weekend. But, you know, Ilya,
I've been avoiding it at all costs.
Good for you. Good for you. You take a look at the headlines this weekend. Friday night, after last call, President Trump made some news headlines, and you got a fast and furious rally in the futures market. I suppose that's a good place to start, where we did have U.S. equity index futures right before the close, 65.23. It bounced back to 65.88, I see here as the last quoted price. But over the weekend, a slew of conflicting headlines, from looking that we're going to wind down the war to we don't even need the Strait of Hormuz. Have you even heard of her? To now a 48-hour imposition by President Trump that if it's not open within 48 hours, well, or else.
Well, and we already have a response from Tehran that says, listen, if you're going to go and if you're going to carry out these attacks on energy infrastructure that you're talking about, we're going to close the whole thing.
It hasn't been
closed. It hasn't been fully closed. We're going to close the whole thing. I don't know if you can say that, really. I mean,
well, the net effect has not been good for oil in the weekend markets. Hyperliquid has an oil contract. IG has the weekend oil contracts. In fact, we could just take a look here what's squeaking on through in the pre-quotes. 97.85 mark close in oil. It looks like we're going to open up close to 100 here in CLK6. For Brent, could be close to $120 a barrel open. Before we get things started, Ilya, it seems like volatility is going to be here, at least in the first few days this week.
Sure.
Buy the rumor, sell the news, or sell the rumor, buy the news as we wait for this 48-hour deadline. Maybe it's going to be an Obama red line like he had with Syria and Assad all those years ago, and nothing happens.
It could be.
I think traders should be prepared for a rocky first few minutes, given what some of the weekend quotes are showing, with oil still pressing higher by 3 to 4%, and stocks down maybe 0.5% or more.
Certainly. I mean, I think we are going to get into an open here that's going to be a little bit dicey. The larger question for me really goes back to that decoupling between oil and risk sentiment that we talked about at the end of last week, where the sentiment took on a life of its own and oil was kind of idling in a range. And nevertheless, we had a situation where stocks were selling off, bonds were screaming lower, and it looked like the inflation kind of extrapolating of higher energy didn't really need the higher energy itself anymore. It seemed like the markets had said, you know what, this is a done deal. This is already in the price. There's no escaping this shock now. Higher rates, weaker risk, higher dollar.
Dollar is definitely going to be in focus in the first half of the week, which brings into question whether or not the market is still reacting to what was a pretty important Fed meeting last week, Ilya.
Yeah.
I know you and I are going to have plenty to say about the Fed here, but when we look at the US dollar, it was able to recover ground almost back to par, near 100, as it were. It does bounce off of its 1-month moving average. So, Ilya, we're going to get these first quotes down the pipeline in a few minutes' time. Friday's volume option, according to SIBO here, as we wait, 82.9 million contracts traded, 23% above recent average levels. Calls leading puts 11 to 10 among the 500 most liquid single stocks. 30-day IVR, or implied volatility, was higher for 43 and lower for 100 here. So we do get those first quotes coming down the pipeline, Ilya. S&P 500 does gap open lower despite the jawboning from the Trump team over the weekend, including Scott Bessent, Treasury Secretary, this morning, off by 0.6%. The Russell off 0.8%. Crypto down 3.5% in Bitcoin, 4.2% in Ethereum, and oil up 2.2% or so. CL is gapping open higher. to the tune of 99.99, briefly flirting with the move
right
through
there.
100 right here. So like we've seen the last few weeks, I think traders, if they're trading oil right now, just some best tips and practices, I guess. It's going to be a wide market here in the first few minutes, first few hours of the open before Asian markets really, truly do come online.
Gold down almost 2% while we're at it.
Gold below $4,500 an ounce. That sucks. It depends upon where you're sitting in the whole situation. Ilya, crude, just gold last week. Last week was my worst week in a very long time. Crude oil here, though, up hanging out near 100 right now. I think if you're looking at the markets, you're going to find very wide markets here at the get-go, depending upon the contract you're traded. The further you go away from the front month, the less liquid it's going to be. The more further away you go out of the money, the less liquid it's going to be. You're going to find 30, 40, 50 cent wide strikes at some point. So, or bid-ask spread at some point. So just keep that in mind as you hunt for a trade. If you're getting into the market, trying to get out of the market, wait for your price, and liquidity probably going to be better by the time we get to the early morning. Of course, 12 hours from now is a lifetime in these markets. Yeah. So we've touched on stocks down a touch here, less than 1%, although getting close in the Russell. For bonds, they're still bleeding out. And I suppose this is the most important driver in the market outside of oil because it's the fulcrum upon which everything else sits.
Indeed.
This does remind me a lot like 2022 right now, where yields are just making their creep higher because we've now entered a higher for longer interest rate environment. And everything else across the risk spectrum needs to be priced around the idea that a hike is more likely than a cut as the Fed's next move, if they're to make a move.
Yeah, I mean, we have a strong gap higher in interest rates here. The bonds are down meaningfully. So you get a sense. I mean, off 0.2% on ZN, 0.3% on ZB. ZT, interestingly, is relatively flat. So it seems like we're really pushing a bunch higher yields down curve. And that just tells you that this is not a market that's looking at even longer term US paper and going, this is a vehicle for safe haven in an uncertain time. Instead, they're saying this is a vehicle for interest rates being higher later. Because if the Fed is going to delay rate cuts now, that means they're going to have to do more of them over time.
More of them over time. 4.403% here on the 10-year yield, Ilya. Oil is feeding directly into this right now.
Yeah.
I mean, it's the same trade, right? To a certain extent, though, as we've seen through all these commodity cycles, and I think this is a really important point to get through here. Oil keeps going up. It reaches a certain point where you reach demand destruction levels. Same thing with fertilizer prices or nitrogen prices or helium prices. Any of these inputs eventually becomes an Ouroboros, a snake eating its own tail.
Yes.
And so this is a trade, right? I want to be very clear about this. You and I, who have been riding oil higher here, in and out on the long side for the past few weeks, before the war, through the war so far, these are trades because if the situation gets bad enough, demand globally falls off and high oil prices inevitably kill the oil price rally.
Yeah, there's a very careful timing component to all of this.
This is nothing to fall in love with right now because if oil then reaches the point where it collapses, the rise in treasury yields probably abates because those inflation expectations come out and then the focus is on the collapse in the growth expectations.
Well, this is right? Exactly right. I mean, this is the essence of what the Fed's been saying, right? The reason why the markets and the Fed have been at odds on policy expectations is the Fed's been saying, look, we got this mandate. It's growth and inflation. If we can't make the rate cuts that you want make sense in that context, you're not getting them. And the markets have been saying, yeah, what we need is insurance because we've got all these balls that we're trying to keep aloft at the same time. And now they've dropped one, maybe two. So this was sort of the essence of the debate. And where we arrived there is the Fed's not going to do anything until the problem is discernible in inflation and growth and employment terms. So you would need to see inflation collapse because the labor market is in a bad way. And then the Fed acts. So you're going to have to wait for this to really become a self eating kind of a thing.
It's not immediate.
No. But
no, and is there a way to
ostensibly,
say
that's what has to happen.
Is it the next 45 and 21 day out cycle? Ilya, quite frankly, if I'm trading oil, I don't know if you're selling vol, you got to go out a little bit. Because to say this is going to be over today.
No, you got to be very careful here. You don't want to sell vol before it's time.
And when will that time come? It's a good question.
I think when you look at the
don't tell you soon,
right? When you look at the current contract, and you look at it on, let's say, a daily chart, 8-hour chart, anything sort of reasonably indicative of the near-term bias, something without so much noise. You look at it and you go, this is a range. And all of the uncertainties about near-term oil prices, because this is a conversation about immediate supply disruption. I don't think you get a clear sense until that range cracks. And maybe that's what we're starting to see here. But so far, it's got a hold on some sort of a reasonable timeline. Daily break, 4-hour break, 8-hour break, something that makes some level of conviction seem like you can extrapolate for at least a week or two.
There's part of me that wanted to talk about
down or up.
There's a part of me that wanted to talk about GameStop earnings and see, would we get a revival of the meme stock craze? But I don't know if this is the week for.
I don't think the risk appetite is there to.
Yeah, I don't think the capital exists. I think those folks got.
This isn't one of those. Sometimes you got to raise chip kind of situations.
No, it's not.
Nobody's trying to race.
No, and so we're going to be very attuned to the news flow. I suppose there's a certain sense, and I seen a tweet come in. Are you surprised that oil's not up more at the start of the week, given the news flow? It did flash above 101, and we talk about the thin markets here at the start of trade. It goes up to 101.5, and now it's back down to 99. It was jumpy, whippy like this each of the past few opens, so I don't think anyone should be shocked. And if it's down to 95, 94, I mean, Ilya, what's the trade then? I'm at the end of last week, I cycled out of, on Futures Power Hour, I cycled out of long call spread in oil and immediately look to get back in. And so through the end of this week, I'm leaning on the long 101, 102 long call spread at 11 days to expiration, long 105, 106. Vol has come into a 70 IVR. I personally think, given the news flow that we're looking at and just hearing what's happening in terms of Arab media and Persian media over the weekend, I've spent far too much time consuming Al Jazeera in the past 2 days. I don't think this. I have a lot of unhealthy habits during times like these. If I've told you that, like, I've watched Al Jazeera, Rachel Maddow, and Nick Fuentes in recent days, alongside Tucker Carlson and everything on CNN. Like, I'm just getting the full range of political spectrums to see, and it's like, I am just frying my brain here, and it's not healthy for me.
Meanwhile, I went to a youth hip hop performance in this little suburb here. The local kids put on a great show. They brought a DJ out. There was some barbecue. The weather was great. It was wonderful.
Yeah. No,
I've avoided all of it completely.
I don't know what I'm doing with my life. Ilya, 25 days, also looking to sell puts. And I think perhaps that's the easier way to play this right now. Even though volatility has come in a little bit, there does seem to be an implicit floor here underneath what's going on.
Yeah.
Which is to say that once we got through 91, 92 in recent sessions, the market, you can see it at the start here on March 11th, but like once you get 91, 92, you start to break out to the upside.
Yeah.
So, the funny thing is, it doesn't really matter who you listen to. If you listen to Republican strategists, you listen to Democratic strategists, you look at people who work in the energy industry, people who work in foreign industry. Steve Bannon had someone on the show the other night, because I'm just curious to see what's filtering through into the president's ecosystem and information sphere.
Sure.
I don't see anyone has an off ramp. The point that all of this build up to is, why am I polluting my brain and wasting my time when I could be with my kids? And as my producer says, touch grass, insert expletive. Fair enough. The consensus right now, it seems to be filtering through into media, is that there is no sort of off ramp, which tells me two things. And this is in response to the question, are you surprised oil is not up more?
Right.
The consensus is that this thing is not ending anytime soon. Right. And so the consensus is that there's everyone is now starting to lean short. Everyone is now starting to be is long oil that wants to be long oil. The buyers are in this market. And so I'm still playing this to the upside in a buy the rumor, sell the news kind of sense. But when this thing breaks, right, if it's because of demand destruction reasons or because there's a ceasefire and some semblance of peace where the strait reopens, it's going to break real hard because consensus on the way this war is working out across the spectrum seems just to be so one-sided right now.
The rubber band has been stretched really, really extensively. Yes.
And there's going to be another big wave of oil volatility. I think more once we get to that point of resolution, if it's whatever form or fashion, because it's just such clear sentiment that this is so disastrous. If it's Breitbart or if it's Financial Times, big Financial Times article over the weekend, Ilya, about the compounding effects, particularly for the semiconductor industry and how it may destroy AI, which is a familiar point you and I have been discussing in recent days. So, I mean, I'm not trying to say this thing's over anytime soon because the news flow over the weekend tells you it's just still going.
Yeah. I mean, I think you get a sense that until you have something materially different, you've got a kind of momentum and a kind of inertia here. And you don't get in its way and you wait. But with the full knowledge that even though, as I think, you have a story about more expensive oil after this war ends. Because you get a regime change tomorrow and what? Iranian George Washington comes out and there's a constitutional convention? No. This is going to be a difficult sort of thing for a while. But the initial market reaction is going to be relief whenever it's over.
Speaking of relief, are we going to see a rewind of the past few weeks where it's like Monday gap open lower, cover the gap, trade open higher, gut into Tuesday, meander out, trade off into the end of the week? Or because this is week 4 of the war, as we outlined on literally day 1, there is a run rate for how much storage can be filled up before too many barrels are shut in, before we talk about like economic calamity that impacts the planet for years. And then 2, you're just running out of munitions to conduct the war at its current pace. We have to scale back in the next few days. We're at the threshold right now. Do you play for that? Do you play for like this thing has to end because the costs of it not ending are so unfathomable?
Yeah. Yeah. I mean, you look at this and you go, okay, so there's a sequencing here. Sequencing number 1 is, oh my God, there's an oil shock. Sequencing number 2 will be, oh good, the immediate oil shock has abated. And sequencing number 3 will be, oh wait, just because we've stopped the immediate war doesn't mean anything has changed as far as stability of oil delivery from Iran for, let's say, a period of months, best case. And then all of your same conversation from the prelude to all of this, we've talked about this extensively, oil has been going up since the beginning of the year. And that's before we started massing forces around Iran. Because Iran was shaky of its own accord. In the context of then what we did in Venezuela, what we did with the tankers, et cetera, et cetera. So there is a prelude and an escalation, and there will be a de-escalation, and then you're back to basically where you were to some extent, probably with more rocks kicked over and more things to fix, and a longer timeline to getting back to oil exports at volume. So there's going to be a sequencing here where at one point oil is going to collapse and then probably find a higher floor than before and then slowly rebuild.
Volatility gaps open here higher, 26.30 right now. VXJ contract is another $1.10. So not that we quote volatility in percentages, but it's a 4% expansion there in the front month, Ilya. So vol is up everywhere, basically everywhere right now. when you look around the market. Even in the metals, you're seeing a little bit of a bounce back. IVR and gold is 68, even though prices continue to decline. But maybe that's the washout sign, Ilya. It was a brutal end to last week for gold prices. Liquidations finally hitting the market Thursday, Friday, the harsh reality of what's happening to the Federal Reserve and how the Fed responds to all of this in the wake of 2022. Hey guys, we all dunked on them for being transitory, too late for too long, too late, Powell. Powell's not going to be too late on inflation this time. And that definitely is the market read through from the Fed meeting last week, Ilya. We take a look at our ZQZ contract. Where will rates be by the end of this year? We were looking at a 3% or so Fed funds rate by December. 3.85 now by December. We're starting to price in hikes. This is a totally different mindset when you and I were having debates about the market going up versus down over recent months, when it's like, well, if the Fed's going to cut, is it a maintenance cut or is it a recession cut? Well, Atlanta Fed GDP is 4%, Ilya. It's going to be a maintenance cut.
Yeah.
That's not the debate. We're not in that regime. We're in a regime where we're coming off of historically high PE ratios where the market abruptly is now pricing in hikes when it thought cuts were coming. It's a horrible situation for
what the markets were afraid
of the short term. And
because
this is the other side of this.
The entire disconnect in markets was this.
Ilya, isn't it even worse because it's not like the war ends, rate cut odds bounce back.
No.
We have a major supply chain issue that if the Fed is smart and learns from its mistakes, it's going to act with a little bit more alacrity, dexterity.
And before we don't give them that credit, as people often like to do, everybody seems to be an armchair Fed chair.
And we are.
We are. We are, but there's certainly there's
another one of my healthy
chorus out there who get in the armchair and decide that the Fed has never done anything good since 1912. So when you get into what the markets are reasonably saying, never mind anybody's Jekyll Island reading opinion, when you look at all of this, you go, what's the market anticipating the Fed to do? And you go, the Fed is being anticipated to be stubborn on inflation. Because otherwise, that's not what we'd be seeing here. The market is very clearly saying the Fed is going to err on the side of keeping inflation contained. They're going to err tighter, not the other way.
Curious. I know that you're not a natural gas trader.
No. I do look at it.
I saw a headline earlier that Qatar's final LNG shipments are on approach to their ports. The flow of liquefied natural gas from the Gulf is expected to come to an abrupt end.
I was almost a natural gas trader at the end of Friday, by the way, and I didn't get filled because I was looking at selling a UNG iron condor with the idea that and keeping it tight around the current range bounds and basically saying, I don't care where you break. Just break. Vol expansion.
Are you in the same vein earlier, just thinking on the tweet that I got about, Are you surprised that oil's not up more given the weekend's news? Forget the fact that gas is down here, 5 cents or so, 6 cents, about a little over, almost 2%. Are you surprised that NG is not trading higher given what we've seen happen in Europe, in the European benchmarks? Because in 2022, when Dutch TTF, the European benchmark, went wild to the upside, eventually someone's got to fill that demand. And so I'm thinking about this FT story about the final LNG shipments from the Gulf approaching ports right now.
Yeah.
I would want to think that this tells me there should be a floor under NG for the foreseeable future because of the shift in demand to our gas.
I think that's
it's
probably,
also not rallying.
I mean, that's reasonable. And you can see it setting higher lows going all the way back to the beginning of the year. So there is something there. I think there's a lot of hope for marginal demand to come out of the U.S. because we are absolutely awash in gas in the U.S. So there is a lot of incremental supply that we could bring about. But when you look at the market here and the price action not reflecting the squeeze, I think what you get is the sense that maybe it's not a squeeze near term because you're approaching summer in Europe. But then the closer you get toward the actual spring to summer transition, then the closer you get to the Europeans starting to buy gas for the winter, because their inventories are now the most drawn down that they've been since 2022. And that's where maybe you get the latent squeeze. So maybe we're just not there yet.
This is the thing. I'm looking at the storage levels going back to COVID, okay?
Yeah.
Right now, the most recently available data, Europe has 1,123.7 billion cubic feet. That's the second lowest amount of storage they've had at this time of the year going back to COVID, except for 2022. Yeah. And they had 995.8 billion cubic feet. And I think about what happened with NG after February 24th, 22. That's the day that Russia invaded Ukraine. It took a little while for our natural gas until like the scope and scale of the supply disruption was realized. And sure, there was a lot big jostle over the summer, but then you rise right back up in August when I think like the per barrel equivalent in terms of joules of energy that you get out of natural gas versus oil. I think the per barrel equivalent of oil that summer in August 22 hit like $550 a barrel. That's how expensive gas was in Europe. So it dragged up our gas prices. Mm-hmm. Most of the facility here, and what's interesting about this Qatar energy facility that was just shut down last week, that constitutes 3.5% of, or 17% of Qatar's energy output or natural gas output, and around 3.5% of total global supply. That facility itself was mainly designed to go to Europe in response to the gas problems they had coming out of the Russia-Ukraine war. So, I mean, I'm just having trouble myself. It feels like this is, I don't want to say a fait accompli, we're just kind of waiting for it to happen. I'm particularly bullish on natural gas. If 2022 is any sort of guide, even though it hasn't really done much of anything here at the first few weeks of this war. Yeah. And for that reason, instead of buying calls and potentially throwing away some premium, which Lord knows I've done enough of in the metals in the past 6 weeks, selling the puts here, rounding out to all of this, selling puts as a way to express that bullishness is, I feel like, the more responsible way to go about this, which I'm currently doing right now with a 2726 put spread, short put spread. But I would like to potentially go into more, keeping in mind that there are just some, again, this is a supply disruption event on the molecular level, and these molecules are not moving. And so I don't know why gas hasn't moved up the way that oil has, but it just feels like if we have any semblance of knowledge of how this commodity space works, having some long delta exposure here could be a prudent thing to do.
Yeah. Yeah. I mean, so what I was looking at here was, look, I'm already pretty long this narrative. I'm very long the bonds, very long the dollar, very long crude. And I've been holding this exposure for weeks now. So I'm kind of deep down the rabbit hole of this narrative as far as my portfolio. It's kind of it's the Stan Druckenmiller approach in some sense, where he says, you know what, some people say don't put all of your eggs in one basket. I like to put all the eggs in one basket and then watch the basket very carefully. So that's sort of where I am here. So I have a macro idea that's working. I have all kinds of exposure around that idea that I've accumulated over a few weeks. And now I'm watching the basket very carefully. So, and adding kind of in spurts where markets are clearing boundaries. So I don't want to over index on all of it, but if I can get a fill, let's say via UNG options to keep things kind of small, stay in ETF world, don't get oversized, then maybe I can get a decent short iron condor thing out there, just looking for the vol to come.
Thinking about this 2726 again, European natural gas inventories are currently standing at 1,124 billion cubic feet. That is 29% capacity overall.
Mhm.
Relative to the 5-year average, the storage deficit is 29.3% below the 5-year average. And in 2022, the last time that inventories were this low, the spring months going into the summer, you saw a big build into August because the companies that handle this business, they're trying to secure the flow now so that they can build the inventories coming out of the summer and into the next winter. So they're still in the phase. This is when they draw down. This is when they typically bottom out. But again, the storage deficit is bigger than it has been over the past 5 years by the tune of 29.3%, according to Gas Infrastructure Europe, which updates their inventory levels every single day. So, Ilya, we have a start to the week here where oil gapped open higher. It came back in a little bit. It's been a jumpy market where we had to move above 100 again. With that pullback in oil, we're getting a very familiar piece of price action here to start the week. Lower stocks to kick things off, and then recovery on Monday because the worst hasn't happened yet. Volatility is up, though, as we kick off this trading week. IVRs for the S&P, for the NASDAQ, for the Russell have all increased here with the start of trading. Volatility futures have increased here at the start of trading, Ilya. We see a further erosion in Fed cut odds. We see a move higher in Treasury yields. We have a U.S. dollar, which for the most part is trading slightly higher. And I'm getting a little bit more long natural gas. Godspeed to myself. Lord knows I need it right now. Ilya, calendar for this week. We could talk about GME earnings, but I suppose we're not in super stonk mode right now. Instead, we could think about the Fed calendar, which now that the Fed meeting has happened, we're going to be hearing from a bunch of these Fed members over the coming days.
It's a pretty busy week for it, as a matter of fact.
Yes. Also, just thinking what's happening here now, the next few days, thinking overnight. The economic data for today isn't really that substantial, I guess. We'll be looking at PMI data from Australia.
The PMI data is going to be very interesting here to start us off, because I think you're going to get a reasonable read on global growth here, and it's going
to covers March, right?
Yes, and I believe actually, let's see. I think. Let me just confirm that. Before we, yes, these are March PMIs. And this is the first batch of them. So
I bring that up because the data that we have seen in recent days and really over the past few weeks is all from pre-war that may not necessarily reflect the change in consumer business behavior, input prices like oil.
That's right.
Again, just penciling out oil, depending upon, if you look at core inflation, it's like a 7% input, but it's 10 for the headline. Oil's up from 60 years to 100. So,
to your point, it will be a timely business cycle look, and it'll be a timely business cycle look across the U.S., across the Eurozone. The U.K. is not the world's hugest economy, but it is something to keep an eye on. Obviously, London continues to be a linchpin as far as financial centers go, especially in a conversation about energy and metals. So that'll be interesting to watch. So UK numbers, Eurozone numbers, US numbers. That'll be really, really curious here, because it'll be an update on the global business cycle, essentially in the teeth of this whole thing.
Ilya, everyone will be back tomorrow morning. The Bats are here to kick things off. Nick and Tony, 8 a.m. Eastern, 7 Central, as we typically do every Monday through Friday here on Tasty Live. I remind people, now that Tasty Live programming is over for this evening, there are a whole bunch of great interviews and videos that you and I have been doing alongside other people on the team.
Yes, sir.
In recent days, I know a bunch of folks have watched the video that I did with Helene Meisler, which I'm greatly appreciative of. I think it has close to 100,000 views now. But I've also done things in recent days with Larry McDonald, Hal Kempfer. You've had some interviews as well, Ilya. You want to pitch them here? I think you spoke with Axel Merck and Ted Horowitz last week.
That's right. So I spoke with Axel Merck about gold, and he runs Merck Investments, which is focused on investing in gold and gold miners. And so with gold kind of oscillating around its role as either a deglobalization thing or a yields and dollar thing, he had some really interesting things to say about kind of the internal mechanics of how gold works as a tradable asset. And then with Todd Horowitz, who's one of the beginning market makers in the S&P pit in Chicago. One of the first came up in the game with people we know, people named Tom Sosnoff. So we had a trading conversation. We were just going through charts and going, how would you structure this? How would you structure that? And he walked people through and said, listen, when you get the washout in oil, here's how I'm structuring that in options. When you get the next leg in gold, here's how I'm structuring that. And so some real hands-on things to take a look at where people can go, oh, well, here's literally the trade construction. And he breaks it all down.
Quick note, postscript here. We do have, we're letting Tony take a vacation. Beth has given him permission to leave the office. He usually sleeps there. Instead, Monday, Tuesday, Jamal and Nick are hosting the morning show. Wednesday, Thursday, Mike and Nick are hosting the morning show. And then Friday, myself and Nick. So come in. Inmates are running the asylum. Tomorrow morning, 8 a.m. Eastern, 7 Central. Live programming resumes. Until then, watch those videos on YouTube. Like, subscribe if you like them. It helps us out here. Good luck. Good luck trading. We'll see everyone tomorrow morning.
See you there, everybody.